September was a pretty crazy month for crypto. So crazy, in fact, that some of the most bullish news managed to slip through the cracks as FUD dominated the headlines. One of those that did slip by was a survey on institutional crypto adoption, a survey with a treasure trove of information. So today I'm going to take you through this report and explain exactly what it means for crypto for the rest of 2021. So don't you dare go anywhere.
Well, ladies and gents, we meet again. It's me, Captain Guy, sailor of the crypto high seas, master of the good ship Coin Bureau, buccaneer, scallywag, bringer of truth and knowledge, at your service. Now, if you would like to join my jolly crew, all you need do is caress that subscribe button and give that little bell a little old ring. That way, YouTube will let you know when the next video is ready to cast off. Do be warned though, although I may be the best dressed crypto educator on the Spanish Main, one thing I ain't is a financial advisor. What that means is that this whole video is for educational and entertainment purposes only, savvy? There are timestamps below if you want to skip around. If you do, I won't tell a soul. But you don't want to miss a single nugget of all this buried treasure though, do you? Right, that's enough from me. Let's see what these landlubbers at Fidelity have got to say for themselves.
So, what is this institutional survey of which I speak? Well, it was the one conducted by Fidelity Digital Investments and released a few weeks ago. 1,100 investors from the USA, Asia and Europe were interviewed, and they came from a whole swathe of different firms, which included the likes of hedge funds, family offices, pension funds, endowments, foundations, etc. Now, this is great as it allows us to get a perspective of how investors with numerous different risk profiles view crypto. It's also fitting for this survey to have been conducted by Fidelity Digital Investments. For those that don't know, this is the crypto division of Fidelity, the fourth largest asset manager in the world, over $3.9 trillion AUM. Fidelity Digital offers numerous services, including execution services, custody, and other client services for institutions. They are perhaps one of the biggest crypto divisions of a TradFi, traditional finance firm, and have been growing at a rapid pace. Now, just to give you an idea of how fast they have been growing, in July, they disclosed that the division is looking to expand headcount by upwards of 70%. This was at a time when the price of Bitcoin was at yearly lows and many retail investors were giving up hope. Apart from this, having the heft of the broader Fidelity group behind Fidelity Digital Assets is a massive advantage. Not only does it show that one of the world's largest asset managers is bullish on the space, but it also means that they can leverage that influence to push forward with crypto adoption. We've seen this more recently with the news that Fidelity has secretly been lobbying the SEC to approve a Bitcoin ETF, something I'll get back to in a bit. Anyways, the report was quite comprehensive and there was so much information to go through. So I thought it was fitting that I took a read through and summarise the most important findings. I also have a few observations that could help to add some context to these. So, with that said, let's jump into the first section, current adoption. The main headline number here is 52%. That is the number of survey participants that have exposure to digital assets of some sort. It's pretty startling when you think about it. More than half of TradFi investors have exposure to crypto. It is, of course, worth pointing out that this distribution is not uniform across geographies. Asian investors have been leading the adoption curve with over 71%. Europe comes in with 56% and the US at 33%. Come on, America, pull your socks up. Now, while that stat may not be the most impressive for my friends from across the pond, it is encouraging to see the growth in these adoption statistics over here. Now, this next slide is pretty illuminating as well. It looks more broadly at how these investors got their exposure to these digital assets. Over in the US, a large proportion of the investors had gained this exposure through an investment product. These include products such as ETPs or other trust vehicles like Grayscale, etc. In other words, US investors were less likely to invest directly in cryptocurrency assets than their European and Asian counterparts. There is perhaps a really strong reason for that, and it is down to regulations. There are very few national regulations that guide investment in digital assets in the US, whereas the guidance is a lot clearer in other countries. This is a good and a bad thing. While it means that these investors are less likely to stack sats themselves, it means they could pile into an exchange-traded product like an ETF if it were to be released. The next slide on takes a look at this adoption based on the particular crypto assets that were invested in. Not surprisingly, Bitcoin and Ether were the predominant assets here. The rest of the asset allocation followed a relatively similar pattern across the other coins here. This does make sense, of course, given that most investors are going to want to start investing in the gold standard of cryptocurrencies. Anyways, this next slide over here gives an overview of how we could see those adoption trends shift over the coming year. All in, 71% of those surveyed indicated that they had a plan to get more crypto exposure over the coming year. This is up considerably from last year, where only 59% of the respondents thought the same. The greatest growth here came from Europe, though, with the US only slightly up. Now, this next slide is also interesting, as it breaks these down according to the type of investor. There are no surprises here, of course. Those that had the highest exposure to crypto were crypto hedge funds and VC investors. They are generally more happy to take on larger levels of risk and hence are happy to invest in crypto. It's also not surprising that in the US and Europe, pensions and endowments are the least likely to invest in crypto. These investors have to be risk-averse given the nature of their obligations. Now, having said that, it seems as if even these investors are beginning to dip their toes into the crypto markets. Another news event that may have escaped your attention this month was the disclosure by 2 Virginia public pension funds that they were investing in crypto investment funds. Now, of course, if we want to further broaden the definition of exposure to crypto, any funds that hold MicroStrategy shares have strong exposure to Bitcoin. These include the likes of the Norwegian Sovereign Wealth Fund, for example. Now, the final page in this adoption section is where they look at the most growth within these different categories of investors. Family offices increased from 19% last year to 47% this year, whereas financial advisors increased from 23% to 43%. Perhaps those financial advisors aren't so bad after all. Maybe I should think about becoming one. Maybe not. Anyways, we finish off this section with a quote from Michael Durbin, the head of Fidelity Digital. Quote, "The study validates what we're hearing from Fidelity's institutional and advisor clients, that demand for digital assets is growing rapidly across segments." This next section is all about the perception of digital assets. You won't, after all, get much more adoption if we constantly have negative views of it. The high-level stats here are that 45% of investors view digital assets positively. This is great to see, although I will say that, much like the previous section, that positive perception is mostly being pulled up by those in Europe and Asia. In the US, more people view crypto negatively than positively. Having said that, the trend appears to be positive. In both the US and Europe, more people are viewing crypto positively, which means that perceptions are a-changing. Perhaps one of the reasons that Asian investors view crypto so positively is the fact that they have been investing in it for a much longer time period. It's quite logical that if you held Bitcoin for over 3 years and saw your investment almost 10x, then you're going to have a better perception than the salty no-coiner who didn't. Now, this slide breaks down those perceptions into the type of funds. The most interesting takeaway here is the fact that after crypto VCs and hedge funds, family offices in the US have the highest percentage of positive or neutral views of crypto. And here in Europe, it was the high net worth individuals, where a full 90% either had a positive or neutral view of crypto. This comes as no surprise, actually. That's because, according to a separate Goldman Sachs survey in July, family offices and the ultra-rich were turning to crypto. Almost 50% of their private wealth clients wanted this exposure in order to hedge, quote, higher inflation, prolonged low rates, and other macroeconomic developments following a year of unprecedented global monetary and fiscal stimulus. Now, of course, it goes without saying that those investors that have the least favourable view of crypto are the pensions and endowment funds. This also explains why so few of them are invested in crypto. But as I explained earlier, they probably already have some exposure in some form without perhaps even knowing it. I do like this quote from the president of Fidelity Digital Assets. As is borne out by the survey, those that still express a skeptical view of the space are evolving in their thinking. Anyways, on to the next section. This section is on the appeal of digital assets. Not surprisingly, the broad appeal of digital assets has grown across regions over the past 3 years. What's interesting, though, are the reasons given as to why these investments are viewed as appealing. They are because of its high potential returns, 43%, innovative technology, 39%, and because it's uncorrelated with other assets, 37%. This is an interesting point, and that's because of how it fits into the well-known investing framework called the modern portfolio theory. The benefits of Bitcoin in traditional portfolios were talked about in this Economist article. I also talked about it in depth in this Telegram post, both of which are linked to below. The TLDR here is that adding Bitcoin to a well-diversified institutional portfolio can not only increase returns, but also reduce overall risk. So, the more asset managers that realize the portfolio diversification benefits of crypto, the more likely we are to have general crypto adoption. That's why the next slide is quite promising. It shows that this investment thesis has been gaining ground in both Europe and the US. This is because of the lack of alternative assets to invest in this incredibly low interest rate environment. As pointed out by the authors, all digital assets have a market cap of only about $2 trillion, when the market cap of gold, for example, is $10 trillion. Speaking of which, here is a fun stat. If you invested $1 in gold 10 years ago, it would be worth 95 cents today. Talk about a store of value. But I digress. Back to the report. What's interesting is some of these other reasons given as to why they would want to invest in crypto assets. 29% of those surveyed liked the fact that it enables decentralization, and 24% liked it because it was free from government intervention. Good to see that we have some idealistic institutions out there. Here on the next slide, they take a look at how those in Asia are investing. What's interesting to note here is that they are increasingly involved in the more exotic crypto investment strategies. These include tactics such as arbitrage and yield opportunities. This is interesting, especially the latter point. That's because, according to a recent report by JP Morgan, over 60% of all DeFi transactions in the second quarter were for over $10 million or more. These are likely to be those institutions that are dabbling in DeFi. It also looks as if funds in the West are starting to diversify their investments into more exotic crypto plays. For example, you had the recent news that hedge funder Steve Cohen has invested in a crypto quant trading firm and an NFT technology company. I also talked about this institutional DeFi shift at greater length in the video I did a few months ago. That's linked to in the top right, so feel free to come back and watch that later. So that's the investment case for crypto. Large asset managers will first be drawn by its diversification benefits, but are likely to want to gravitate to the more exotic investments as they become more comfortable. On to the next section, though, and this is barriers to adoption. Unsurprisingly, one of the predominant barriers to adoption in their eyes is the price volatility of crypto. These concerns have increased year over year in Europe and the US. I should also point out that this was in the context of some of the largest falls and rallies that Bitcoin has seen. The past year was incredibly volatile for the asset, and this is something that most of the mainstream media will harp on about. Therefore, it's what is front and center in the minds of these institutions. Now, while this volatility may be seen as a barrier, I will point out that on a risk-adjusted basis, Bitcoin is still best. This is something that Coinbase detailed in its H1 institutional report. I don't have the time to go into it in detail, so feel free to watch my video on it after this one. But the point is that if we were to look at risk-adjusted ratios for Bitcoin and Ether, it's better than many of the other traditional assets out there. And as I mentioned earlier, the risk itself is of less importance for a well-diversified portfolio. As long as the correlation is low, it can actually help to reduce overall risk. Anywho, another barrier to adoption that these investors see is that it's hard to value digital assets. This is a fair point, and that's because most traditional valuation models like financial ratios or discounted cash flows cannot be used. However, there are some methods that are specific to digital networks that can be used. I'll leave a link to my video on Bitcoin valuation in the description below if you want more context there. Now, taking a look at some of the other barriers that these investors foresee, we have security of funds, regulatory uncertainty, and market manipulation. These are also all valid, and these are all as a result of that regulatory clarity point. Investors don't know how safe funds are if you don't have a regulatory framework for crypto custodians, and market manipulation is rife in a sector where there is too little regulatory oversight. Too bad that the regulators are too preoccupied with clamping down on innovation rather than crafting smart crypto laws. But hey, someone has to protect those vulnerable banks, right? Now, breaking down these concerns into different investor segments, it's unsurprising to see that those that have the most concerns about the volatility are pension funds and endowments. A full 73% of those US-based funds and endowments are worried about that volatility. Can't have grandma's pension invested in Bitcoin, can we? That all said, according to Chris Tyra of Fidelity Digital in Europe, there is a great deal of progress being made in Europe to harmonise digital asset regulation across the continent. This is through the MiCA, or Markets in Crypto Assets proposal. Never did I think that I would see the day when European regulators would have been more proactive on this than those in the US. Now let's move on though, as the last two sections are particularly juicy. In this section, they start talking about the various digital asset investment products out there. These are assets such as ETPs, trusts, ETFs, etc., etc. What's so interesting about this is the large amount of interest there is from these institutional investors in holding these types of products. Over in the US and Europe, 84% of the respondents said that they would be interested in investing in these types of products. In Asia, it was even higher at 90%. Furthermore, investors in Europe and the US are increasingly willing to invest in these types of products that have exposure to more than one digital asset. Of course, there is still a high demand for single asset investment products, and that which is of most interest is Bitcoin. This is something that we have seen over the year, as more investors line up to buy shares in ETPs or Grayscale's Bitcoin Trust. However, the latter has been less than optimal given its mandatory lockups and premiums/discounts. It's quite clear that institutional investors are looking for another, more liquid vehicle for them to gain exposure to Bitcoin. And this then brings me on to this page, which looks at investor perceptions towards ETFs or exchange-traded funds. As you know, this has been one of the hottest topics in the crypto space for a number of years. The overwhelming majority of investors here hold a neutral to positive view of Bitcoin ETFs. What this means is that should one of these eventually get issued in the US, there could be a flood of institutional money that could flow into it, and the others that will surely follow. On that front, there are already a raft of Bitcoin ETF applications that are waiting at the door of the SEC. One of those applications is Fidelity's own proposal, and it was recently disclosed that Fidelity has been pushing the SEC in secret meetings to approve it. It's for these reasons that some think that we are likely to see one of these applications being approved this October. What impact this will have on the price of Bitcoin depends on what type of ETF is issued, physical or futures-backed. Now, I've covered this in greater detail in my video on futures-backed ETFs, top right, por favor. This next slide here just drills down into a bit more detail based on the investor type. Unsurprisingly, the willingness to invest in actively managed crypto funds reflects the risk profile of these different investors. Something that has picked up a lot over the past year is the interest of these funds in what is called factor-based investing. The authors think that one of the biggest drivers for this was the growth of Ethereum over the past year. It has presented more experienced crypto-native investors with the opportunity to extract value from within the Ethereum ecosystem, something that further explains that institutional DeFi adoption I spoke about earlier. The final section I quickly want to touch on is one that I'm not so bullish on, and that is CBDCs. I've talked about central bank digital currencies ad nauseum on this channel and have made it quite clear that I am not a fan. So it was interesting to see what these institutional investors think about these centrally issued shitcoins. It's pretty disappointing to see that most of these investors have an appealing or neutral view towards it. Thankfully, our friends out in the US of A are the shining examples here, with 47% of those investors having a negative view towards it. That's more like it, guys. However, this doesn't change the fact that a full 53% of all those surveyed think we are likely to see a US CBDC within the next 5 years, and 38% see it in 3 years. Pretty damn scary. Taking a bit of a closer look into the investor segments, you can see that those that think it is likely are those that know the crypto space well. This is because they've been keeping track of what has been going on over at the Fed. If you don't know what I'm talking about, then you may want to watch my video, which takes a look at what the Fed thinks of crypto. The TLDR there is that the Fed has been increasingly bullish on the prospects of a digital dollar and has been talking up the benefits of a Fed-issued one. This has all been done at a time when it has actively been spreading FUD about other stablecoins and cryptocurrencies more generally. It's also not just a theoretical construct. The Chinese are moving full steam ahead with their digital e-yuan, and this is perhaps one of the primary reasons for their recent cryptocurrency ban. I sincerely hope that something like that is not on the cards in the West. But given what has happened in the world over the past 2 years, nothing is impossible. That's it for most of the report. It really was an insightful read, and I've left it in the description for you guys in case you wanted to read it yourselves. The most important takeaways for me are that institutional adoption is still moving ahead at a rapid pace. While many still remain skeptical, there is equal institutional FOMO. There is a reason why investors such as Paul Tudor-Jones, Stanley Druckenmiller, and Steve Cohen have dived into the crypto waters. They understand the fundamental shift that's occurring beneath our feet. Of course, one can't expect a pension fund or endowment to have the same view of crypto as a hedge fund manager. They have different risk profiles and stakeholders. However, as more of them realize the diversification benefits that come from crypto, the more likely they are to allocate portions of their mammoth portfolios to it. And if those stats about Bitcoin ETFs are correct, it shows that these investors are just waiting for an opportunity to invest in one. This is why I'm so excited about the prospect of an ETF this October. Now, while this report has left me bullish for the longer term, we cannot ignore some very real risks that could lurk around the corner. Regulators and lawmakers are getting increasingly active in their clampdown on crypto. While some guidance is welcome, the tactic they have employed seems to be more of a hammer than a scalpel. And of course, we cannot ignore the risks that are posed by potential incoming CBDCs. If this survey is to be believed, more than half of these well-informed and smart investors think we will see a US digital dollar in less than 5 years. If that is indeed the case, then the crypto investment case won't be about returns, but more about freedom from central bank tyranny. Satoshi would be proud. And that's just about it, folks, but I'm keen to hear your all-important feedback. So what do you guys think of the findings in this report? YOLO, you know, so fire those comments down below. And while you're tapping away down there, you absolutely have to know about my socials page. This is a web page that has the links to all the other official places to follow me. These include my Telegram Insider channel with daily market updates, my Twitter for announcements and the occasional story, my Instagram and TikTok for behind-the-scenes fun and memes, and the creme de la creme, the meat and potatoes, the cherry on top, my weekly newsletter. It's here that I share my crypto tips as well as a breakdown of my personal portfolio. So be sure to head down below and hit that top link in the description. Now, if you guys liked this guy's vid, share the love. Hit the like and tap that subscribe. Ping that bell as well for good measure. You don't want to miss what else I have coming. Till next time, ta-ta, me hearties.